Awesome. Well, yeah, I want to welcome everybody. I can only see you and I, Steph. I can't see anybody else. So I want to welcome everybody for joining us here today and appreciate everybody carving some time here in the afternoon to talk with Stephanie and I. I want to definitely make sure that we're focusing on some of the key themes that Stephanie is going to be looking at this year. It's obviously going to be an exciting year, it would seem. We've got a new Fed chair coming in, we've got a midterm coming up, and all the fun and frolic that comes with that. So I'm sure that you have a number of different topics that you want to cover. Obviously, what's going on with the Atlanta Fed tracker this week. Heard some of the comments you made earlier this week on CNBC. So really just excited to kick us off here. Really want to just start with your themes if we can, Steph, and just kick the ball around the field and see where we go from there.
Sure. And like we usually do, Steve, I love to ham and egg it with you and we just kind of see where it takes us. So great to be here. And really enjoy spending time with you and with everyone else and trying to start the year off with a couple of ideas and thoughts. Before I get into themes, Steve, was surprised once again by the Atlanta Fed tracker that came out just this afternoon. We are now at 5.3%. So I'm sure that that was what you were alluding to, that the number continues to just creep higher and higher and higher. And what's interesting about the numbers, we use Atlanta Fed and the tracker for a direction. It's never precise. However, the direction has been going higher and higher and higher. And that is despite the fact that we had the close down in November with the government, we probably would have seen something closer to 7% growth. And why is that? Well, it ties into two really big themes you and I've talked about. Number one, the consumer. Consumer continues to consume. And that is because they have jobs in terms of weekly jobless claims, which is what I look at. I know you look at it too. We smooth it out. The 3-month moving average is about 212,000. And that's the number on a real-time basis. And we know that during a recession, the weekly jobless claims can get as high as 350 to 375. So there's one job available in this country for one unemployed person. Is it slowing down? Yeah, it is slowing down, but the labor market is still solid. And that's important because if a consumer has a job, they're spending. We are a nation of spenders, as you know. Inflation has come down from 9% in 2022 to about 3.5% today. We got a bad PPI number, but it's come down. It is sticky, but you've heard me say this, and I will continue to say it. I would much rather have faster growth in terms of GDP and a little higher inflation, because from a corporate profits point of view, that is very positive. Companies have pricing power on the margin side, and they also have better demand. So you'll see profits, and I think profits are likely to go higher. I'm thinking right now 10 to 12% for the year. There are numbers as high as 16, 17%. Not sure we can get there, but we'll have to see. I think 10 to 12% is enough. Is it enough to see another double-digit gain in the S&P 500? I don't know. We grew 16% last year in equities. We 23% the year prior, and then 24% 3 years ago. Those are enormous numbers. The historical average is 7.7%, so we're way above normal, but we're also way above normal in growth. So start off consumer, I want to have exposure to discretionary companies. I think that if you have the right products, people will buy them. Services is off the charts. Look at what Delta reported earlier this week. And now I know they saw 9% growth in the front part of the cabin, not so much in the back part, but they're spending. And that's helping companies, again, with pricing power and better demand. So we're seeing services continue to do fairly well. Goods, it's very hit or miss, but I think if you have the right product, you'll continue to see positive reactions. And I own a couple of names we can talk about if we like. And then I think the most important part is, do we ever get a housing cycle? We haven't had a housing cycle and we're growing 5%. You know, I'm a believer in housing. I have been. It's been wrong, but that is part of the consumer theme. And then the other reason that we're growing so much is definitely the AI momentum. I do not think it's a bubble because so many different industries are impacted, meaning the food chain is enormous. It is certainly Mag 7 or 10 or whatever you want to say. Technology is definitely spending the dollars, but it's feeding into the data center makers. It's feeding into the grid repair, if you will. I mean, we're not going to get a new grid, but it's the repair, and we haven't added incremental dollars in 50 years. And then, of course, it's power, and we just simply do not have enough. When you see headlines like Meta last week talking about a huge billions of dollar deal with Vistra just to get nuclear, that is a statement. It's not going to be just nuclear. It's not going to just be renewables. It's not just going to be natural gas. It could be also traditional energy. There's a lot of places here where you're going to get power, but we still don't have enough. And so that is another big theme, but it is helping to drive our economy. Again, if we get a housing cycle, Katie bar the door in my mind in terms of growth, but we're not there yet, and that's going to take some time. I can list a few more. I could list a few more themes if you like, Steve, or if or maybe some of my newer ones, or it's up to you, wherever you want to go.
Yeah, I mean, I'd like to hit on a couple of things that you mentioned and maybe go back a little bit. So,
Okay.
if we're looking at this particular environment that we're staring at today, the normalization of the yield curve finally coming into play, right? And you're starting to see some of these things start to look a little bit better from that forecasting mechanism of looking at the shape of the yield curve, right? What do you see would be a driver and a catalyst, whether it be the Fed, whether it be intervention from various policymakers to actually spur that real estate growth that we're all hoping for?
I know that we're all hoping for. You're right. We need lower rates. It's as simple as that. And the 30-year fixed mortgage rate is not based on the Fed funds rate. We know it's based on the 10-year. And my argument is that yields are actually inching a little bit higher. We're steepening just a little bit because the growth is there. That's my opinion. But the spread between the 30-year Treasury and the 30-year mortgage is actually that spread is actually getting less and less. It's tightening. And that actually has led to, and I'd love your opinion on that, but we have seen as a result the 30-year fixed mortgage rate actually fall. In addition, we have Fannie and Freddie buying $200 billion in the bond market, which is also helping. So if we get interest rates, and we did last week very briefly, depending on what you're looking at, but we had the 30-year mortgage fall below 6 very briefly. But if it got into the mid 5s, that is, in fact, I think what will drive more demand. Of course, more supply will help as well in terms of pricing. But we do have pockets of big supply in this country, Southeast, Southwest in particular. And that hasn't necessarily helped on the demand side, not just yet anyway. What about you?
Yeah, I mean, I look at this movement that we've had in the 10-year. I was a little surprised actually that there wasn't a little bit more concern that came out of some of our activities in South America over the last week and a half.
Yeah.
Little surprised that the 10-year decided to creep up to that 420 and kind of sit there for a minute. And we've really traded very range bound in that 10-year, right? I mean, we're like a
Yeah.
408 to a 421, and depending on which headline you look at on any given day, it's going to move up one or two and move down one or two the next day. Nothing really tangible. And I think going back to your point, that 10-year is not going to come down with any significance if we continue to print GDP and inflation remains relatively elevated.
I know.
I
I
think
mean,
two is a foregone conclusion that we're not going to touch two on the inflation number that we want to be targeting. 2.5, okay, fine. But if we're going to remain elevated, there's no real reason for the 10-year to continue to come down. The other comments that have been coming out recently, really in the last, call it 4 or 5 days, I guess, is the idea that if we are going to continue to print this expansive GDP that is running hotter than I think we were expecting, especially coming off of the November environment, looking at that, right? I mean, the 10-year is not going to price down in
yeah.
terms of yields if GDP is ripping like that. And it also opens up the conversation about whether or not the Fed's going to really need to cut. So do I think they're going to cut? Yeah, I think they're going to be told to cut, right? We
Yeah.
have this midterm in 10 months, right? We want to make sure that popularity, depending on who's in office at any given time, they don't want to let their popularity wane. So do I think they're probably going to get it still? Yeah, but the debate's there on whether or not they really need to.
For
And I think
sure.
that's going to have some impact also to that rate environment that we're talking about and whether or not that can bring down that mortgage rate to that 5.5.
So I would agree with you 100% that we don't need to cut, not with 5% growth, not with corporate earnings running 15, 16%, which they just did. We have enough demand in a lot of places. We know the consumer is K-shaped. That's always the case, by the way, unfortunately. I wish it wasn't. but you have the upper end consumer since 2019 see $60 trillion worth of net worth gains. Think about that.
Wow.
And that's between
Wow.
the stock market, that's between owning homes, one home, many homes, whatever it is. And that's very powerful. That's why the upper end is doing well. And they're spending, because we're seeing it all over the place. You see it in retail sales, you see it in holiday sales, you see it across the board. Today, we got a good retail sales number. The lower end is what I think the administration is trying to focus on in terms of affordability. And that's what lower interest rates would help. Maybe it would help in terms of, again, a housing cycle for them to actually own a home to create net worth, also just affordability in general. But I'm not sure that we're going to see a lot of them. Sure, the next Fed chair is going to be a Dove. We know that. But that job is not just a one-person job. That
Right.
job is to corral the entire committee and to try to get them all on one page. And I think that's going to be really hard if you have continued elevated inflation. Now, look, I don't pay as much attention to PPI as I do CPI. And CPI, the core number at 2.6 was fine. I mean, it's not 2, but it's fine. But we'll have to watch various different, a variety of different metrics. I will say one thing about last week that kind of struck a chord, and I'm curious as to what you think. We got 4.9% productivity growth. And at the same time, we had unit labor costs down almost 2%. I don't know about you, but to me, that's Goldilocks. That's good growth, not a lot of labor cost inflation. That is harmony for companies and for, again, corporate profits. To me, that productivity is AI. And that's why another reason why I don't think AI is a bubble, because of the productivity and the ROIs that companies are just starting to see. But it's very, very powerful. And I don't know about you, I haven't seen a 4.9 productivity number, I don't know, maybe in 35 years. Seriously.
Yeah. No, and I agree. And going back to the idea that like AI is transformative, right? Of course, right?
Yeah.
There's no way that it's not going to be,
Yeah.
right? Sometimes it does concern me a little bit that sometimes we try to be too smart for our own good sometimes. That being said, if it's going to produce the corporate profits that are going to drive the markets higher, then great, let's do it.
Yeah.
Big fan, right? On
Yeah.
behalf of all of our clients, our advisors, and everybody. So great, and like you said, it is in fact a Goldilocks situation, but we'll take it while it's here.
Yeah.
I don't want to lick a
Absolutely.
gift horse in the mouth, but I do want to celebrate the fact that we're here right now, and let's go ahead and celebrate that.
For sure. And then I know I've been talking about cybersecurity forever, and I've always said that cybersecurity is going to be bigger than AI. Here's the reason. Do you know that there are only 4 companies that I got the actual numbers from, but Robinhood, Coinbase, Microsoft, and Alphabet are all spending 30 to 50% of with using AI to code, right? So you're not using people. So 30 to 50% increase. The numbers are still off of a very low base. I get it. But that's even another reason why we need cybersecurity, because the attacks are going to be ferocious. And it's every other day we're hearing about a big company. And that is something that I think is with us for a very, very long time, decades, in fact. And I'm particularly encouraged, you and I have talked about how we expect M&A to be rampant in the industry because there are 4,000 players and companies are looking for opportunity to offer more to their customers. Well, I'm very encouraged. Something like a Palo Alto in the last 4 months, they've made 4 acquisitions totaling $30 billion. Now, people don't like it because they're afraid that the management can't handle 4 acquisitions. It's a little unnerving. I get it. They will. If any management can do it, they can. However, it's just the point. And we're hearing other companies, as ServiceNow made an acquisition most recently, CrowdStrike every other day. They're going about it a little differently because they're buying much smaller players, but it's happening. And so that those two, so AI and consumer and cyber have been themes of mine for a long time, but I just keep piling up the data points and I still want to be absolutely involved. A couple of new things for me in terms of themes. Energy, I've been adding to energy. It's the year, and it has been last year as well, of the commodity prices increasing. But it's not just gold and silver. It's palladium, it's platinum, it's copper. I'm a huge fan of copper, which is one of the reasons I own Antofagasta. But I think you have to have exposure there. And I think you're starting to see energy prices creep higher. Now, we have an administration that is hell bent on getting to $50 oil, so I am not going to put a lot of muscle behind oil prices rising substantially. But the stocks themselves are acting so much better. And I think a lot of it is because, well, they too can help on the whole power situation in terms of AI, but also you're seeing depletion rates in US shale fall rapidly, right? I mean, well, I should say depletion rates are actually increasing rapidly. They're going down. They're going really down. And you have OPEC Plus is more disciplined as well. And so I don't know what's going to happen in terms of Venezuela. I think whatever happens is going to be a long-term thing. So, but I do think that the oil services companies and the infrastructure companies will see a nice bump if we do, in fact, reposition the whole energy complex in Venezuela. So that's a fairly new theme for me. Quantum computing is a very big theme that you and I started talking about it last year, I know, but what struck me is, well, IBM thinks it's a $100 billion total addressable market. And oh, by the way, they're the number one player in quantum. No one would think such a thing. I barely can believe it. But the other thing is they actually came out with, I think it was like around October of last year. They came out with a stat. They said that they saw a 34% increase in accuracy and also in volumes in algorithm trading just by using quantum computing. That kind of got my ear like, because I was thinking maybe quantum computing is like a 2029, 2030 kind of theme. The companies then I talked to our chief technology officer, and he said, yeah, we have to start to think about how we're going to start to deploy. Even in the beginning, we have to start thinking about it now. And so I do think that certainly is going to gain some speed. Automation and robotics, I've talked about, but I believe very strongly you're in the second or third inning. When you hear Amazon say they had a 5% increase in productivity by using robotics, and you have Walmart saying that they saw a double-digit decline in shipping costs because of automation and robotics, those are real numbers, and I pay attention to it. And then I would just say that somewhere in your portfolio, and I'm going to say it, a very small piece, a very, very, very small piece, I think you should own some sort of crypto. And I don't say it because I have a handle on what the price of Bitcoin is going to do. I personally think that no one has any idea what the price is going to do. I'm buying the exchanges because I believe all you need is a buyer and a seller, not necessarily the actual price. But I think about the generation, your kids, my kid, what they're doing. And they are so more sophisticated than I am. I can tell you that. They are very interested. It's an alternative source. It's of an investment. Is it a gold substitute? No, I don't think so. But I think that the $3 to $5 trillion total addressable market can go higher. So when I say small, like I want nothing more than 2% because I can't sleep at night. But I do think you want to have some because I think it's also sort of fun to learn about it as well.
Absolutely. Well,
Yeah.
that's the thing too, that around the idea of it, or any of that area of the market, it's a toll road, right?
Yeah.
It's a
Yeah.
toll road. So yeah,
Yeah.
it's going to get headlines. It's going to get whipped around depending on what's happening with the underlying. I hesitate to call it a currency price; it's more of a commodity price in the way that it
Yes.
trades. But
Agreed.
that being said, you're clipping revenue when they place the trade, whether it's up or down. Somebody's a buyer, like you said. Somebody's a buyer, somebody's a seller,
Right. I
and
agree.
not being able to, like you said, fundamentally price or value a currency or a commodity or however we want to look at it. Well, that's a great way to play it and explore it and participate in it without having to go take direct exposure into something that, frankly, nobody really knows how to fundamentally value.
100%. I think we're getting looks. What do you think? I think we're getting looks in the financials this week because they act like crap on earnings. They always act like crap on earnings. They
Every time.
just do because I just don't. They're so complex. People focus on a million different things, and rarely is it the right thing. But we got reports from J.P. Morgan, Bank of America, Wells Fargo, and all the stocks are down. They also ran 25 to 35% in the past year. Expectations were quite high, but I do believe in owning financials. I'm overweight financials. And a lot of it is because of the economy. I mean, if we're growing 5%, they have to be lending 5% or more. And we actually learned at least from the three, that they are. The loan growth is about 6% on average. Net interest income, as the yield curve steepens, they should see better results there. All of the companies either reiterated for net interest income for this year or raised slightly. They're doing a good job in expense control. M&A is off the charts, grew 27% last year. That's good. And deregulation, not from an M&A point of view, to be honest with you, but deregulation from a capital allocation point of view, I think is really what is going to help increase the announcements of buybacks and dividends, et cetera. So to me, I think you take advantage of the dislocations during earnings. You know, I call earnings season silly season. I think you're getting a chance to buy a lot of great companies. So that is something that I want to really do focus on because of just the way they're trading. And I think there is a real opportunity there.
So when you think about banks, or specifically depository banks, right? Not necessarily the IB guys or whatever, but the bank centers, right? How do you feel like that plays into your feelings about the consumer? So when I hear you talk about the idea that loan growth is expanding, right? We're lifting the caps, we're making some of these changes, going back to the idea that Americans especially are really, really good at spending money. We have become phenomenal at it.
Me too.
Even, oh, I'd be guilty as charged, right? Of course. But that being said, we've also proven our willingness that if even if we can't afford it, we'll borrow from somebody to go buy it because we're not going to stop buying it, whether we've got the money or not. So, do you see that there's a corollary there? Do you think about them completely separately, or do you look at a corollary there between your sentiments on the consumer, the expansion there, the jobs numbers that we're seeing, GDP expansion, which of course is driven 70% by consumer, 75% of that by services, and you see that circling back into your bank profitability because of the loan situation?
I think you're seeing activity increase, which is what has been really nice. And I look at, and I know you look at it too, the weekly Federal Reserve H8 data. And basically they release it. The Federal Reserve releases what the banks are doing in terms of deposits and loan growth, et cetera. And 11 out of the last 13 weeks, it's actually increased and it's at record levels. And so I think, yes, it feeds right into the consumer. They are lending out, but the companies are seeing really good credit quality, right? So all of the big six banks have FICO scores over 750. I think that they have done a very good job with discipline, and I think they will continue. At least the big guys will, and some of the super regionals as well. So I think the two go hand in hand. To your point, and I think that's a really important point. Now, look, if they go to caps on credit cards, which I do not think they will, because guess what? Banks are going to just withhold; they won't lend, and that will be very restrictive. And the lower end consumer will have to find alternative ways to finance, which will be higher probably. So to me, I think it's I mean, it sounds good from the administration wanting to help. I get it. No one wants to pay 36% on a loan. However, the big banks that got hit hard in it, I think really didn't deserve to be. I would say just I don't know how long we're supposed to talk for, but one last thing in terms of international. I sold out of India because I didn't have any cash, and I really think Brazil is going to outperform India this year. That being said, I'm looking for every excuse to find some cash to buy India because it didn't do well last year. It was flat on the year when the whole world was up. So I'm just stay tuned. I'm probably going to go back because I still like the theme very, very much. This was a tactical thing for me. India is still going to grow the fastest in the world. They still have a prime minister and administration that's pro-business, pro-consumer. You have the whole moving up from the low end of the consumer to the middle. You have infrastructure galore, at 1.7 trillion in infrastructure spend between now and 2030. So still want to be there very much. Brazil, on the same token, the demographics are very, very favorable. They're going to grow about 3 to 4% this year. They have a new administration that will be lowering interest rates, fiscal policies, monetary policies to help stimulate their country. And if you and I are right on commodities, this is a way to play it, right? They do manufacturing, they do mining, they're huge in copper, and also financials. The financial system is really shored up. So I'm going to do the same thing like I did with India in terms of being involved in an ETF because I don't have the sophistication, I don't have the expertise on specific Brazilian companies. But I do think that that is a place where you want to have exposure. China, I think, is still a place that is starting to see a little bit of momentum. I would much rather play US dominated companies that have exposure to China. I have enough exposure to China if China goes. And I'd much rather do it that way. I'm not, I would fade Europe. I think that Europe has gone up a lot. It's not as cheap, and I think the margin upside is much more limited versus any of the companies in the US for that matter. We have margin opportunity. Europe really doesn't. And so I think it's had a nice run. And again, I want to size international appropriately, 10% max in the portfolio. I don't have 10% actually. I only have a couple percent, but my multinationals certainly give me the exposure on that as well.
Yeah. Yeah. Going back to the India trade and the swap into Brazil, I mean, the theme, to use your word, right, the theme behind that really is just in what we've talked about in the last, call it 12 months, is the idea that we're skating to where the puck is going as opposed to
Yeah.
where it is,
Yeah.
right? We have an
Right.
expanding consumer base that has over 1 billion people that are going to continue to graduate the way up the scale of how they spend money.
Yeah.
So great. And if we can take profits along the way, or we have a year that's relatively flat, we have a better opportunity in the short term. Great. Let's be tactical. Let's trade. Let's trade that theme. But that's a 10-year theme,
Yeah.
right? That's a decade-long theme that we can trade into and out of or stay long depending on where we are valuation-wise in other markets.
Absolutely.
And we're
So
just betting on the consumer again, ironically enough.
there we go, which has proven to be the right thing to do, no matter what country you're in. Talk a little bit about where you are seeing opportunities in fixed income.
Yeah. So one of the things that's actually been really, really interesting is watching what's happened with the mob spread. So obviously we had a number of different headlines that came our way around what's gone on in Minneapolis, and we've had a number of questions that have come our way recently about concerns about municipal credit quality as a result of there being potentially an expansive coverage, we'll say, of these types of things that may be out there looming. Sounds very, very reminiscent of Meredith Whitney, right? Of 2009-10 fame, right?
Yeah.
The reality is that underlying fundamentals of credit quality and munis are really not that impacted. A lot of the bonds are going to be constitutionally mandated to be paid, even here in the People's Republic of California, right? We're constitutionally mandated to pay at least that 60% budget allocation to pay our debt, and we send IOUs to everybody who's not in line.
Yeah.
So the credit quality impact issue really is not a concern. If it were, you would not see a 63% mob spread on the 10-year.
Mm.
So we're flirting with a 414 close, 415 close, maybe on the 10-year. I didn't see it right at the close here. But with munis at a 260 10-year national MMD against a 414, that's 63%. That's a relatively rich market.
Yeah.
So if there were any underlying cracks or issues that were really forming in the credit space and the credit world around muni credit, you wouldn't be looking at us in a market that expensive.
Wow. That's incredible.
Yeah, and part of that's supply constraint, right?
Yeah.
New issue
Yeah.
supply constraint. But I think you're going to see some of that continue to come online because we've got a reissuance problem to refund some of this outstanding debt from a decade ago. So we will potentially see some additional supply hit the metrics here, but reality, we're going to have more than enough people that are going to line up to buy that tax-free credit.
You know what's interesting? I think the 60/40 asset allocation last year surprised everybody. It kind of worked. It did pretty
18 months
well.
ago, it was dead, Stephanie.
I
Remember, it was
know.
dead. Nobody talks about that boring old 60/40 anymore,
I
Stephanie.
know.
We got to be creative.
I know. Well, we knew it was we knew it was peak bad when Barron's came out and said maybe we have to rethink 60/40. I don't know. It did pretty well if you're 60/40. Now look, I mean, I know that the private market space or commodity space or real estate, you always want to have some diversification. And I have no problem with that whatsoever. But it wasn't dead. 60/40 actually did pretty good.
Absolutely. Well, and I think that you're going to continue to see that out of fixed income. I'm enthused that the yield environment we're seeing in investment grade corporates, spreads are somewhat narrow, but they're not super unattractive. They're not as attractive as they once were, but they're not terrible, right?
Yeah.
And you're still seeing again that 10-year to 420 is really not a bad trade. I love the macro trade there. And looking at an environment where you can play bond roll again, right? That U-shaped, inverted, quasi-inverted, whatever we want to call it, yield curve that we were having, where the 2-year was down, the 5-year was down, but 10 and 3 months were the same. Well, that's a pretty difficult market to play bond roll.
Yeah.
But in an environment where the curve is at least normal-ish or normal adjacent, you can put a 420 10-year on a trade and hold it for 3 years and be willing to sell it and play the bond roll mechanic and find outperformance against your short-term paper, as we know or expect the Fed's going to continue to cut rates.
Yeah.
So to go back to your question about where I think there's opportunity, ironically enough, I like the 10-year. I also
Wow.
like callable agencies. And we play in a very what most people would consider to be a boring world, right? For bond geeks, it's not a boring world, but for most people, it's a boring world. Anytime I can look at an opportunity where I think the probabilities are such that the Fed's going to cut, the agencies and the FFCB and the FHLB bonds that are floated out there right now, 15, 20 years callable in a year, and I'm locking above a 5 state tax exempt against a 3 month or a 6 month that's going to continue to come down into the low to mid threes, I'll take 150 basis points of outperformance and get called away. I think a lot of folks get sucked into the idea that they're afraid to get called away because then they've got to go replace it. But yeah, but I made 150 basis points over for 6 months. Okay. Your cash yield's going to go down. Your 6 month T-bill you've been rolling is going to go down. I locked you in at a 5+ state tax exempt. If you get yanked in 6 months, fine. You get yanked in a year, fine. What did we lose by it? Nothing.
I actually don't recall hearing you this optimistic.
I know.
I think in the last year you definitely were much, much more so than maybe 3 years ago. I don't know. We've been doing this together for such a long time, but I think that's really fun that you can do there. There is an alternative, right? There
There
are
is an alternative.
ideas out
Exactly.
there. That's pretty cool.
Exactly. Yeah. Going through 4 years of a 10-year at a 1.5 or lower was pretty unpopular for people like
Yeah.
me. So
Yeah.
now we get a seat at the table again. We don't have to drink out of the sippy cup anymore. We get to actually have a conversation with the grown-ups. So it's a fun environment to be in for sure.
I love it. I absolutely love it. Well, I think we're out of time, right? We're supposed to do this for like 35 minutes or so.
I mean, we could go for another hour if you want, but I don't know if we're going to keep all 110 participants on, but we can keep going if you'd like.
Well, I'll always do this with you for
Absolutely. Me
however
too.
as long you want me to. So it's always so much fun to be with you and just to talk about things and look forward to doing it in NorCal when
Absolutely.
this year.
March,
And
Marchish time frame, I believe, is when we're doing that. Or April.
I can't wait. And for the rest of Hightower Signature Wealth, and wherever I'm needed, it's great. So but thank you for your time. I really
Thank you.
appreciate it.
Great to
Okay.
see you.
See you soon. Take
All
care.
right. Bye, everybody.